Welcome to Talk Tickers, your essential briefing for breaking down the latest earnings calls. Today, we're dissecting the Q1 FY26 results for Ryanair Holdings PLC. We've gone through the earnings call, the management discussion, really pulled out the core insights to bring you the critical takeaways. Our aim is to help you cut through all that data, understand what truly matters, basically give you a focused analysis, maybe with a few surprising facts, key insights, just so you're well informed on this important company.
Precisely. We'll synthesize, the key financials, management strategic thinking, and what it all means for the broader European airline sector. So you can grasp not just what they said, but why it's significant and what kind of signals it sends for the future.
Okay, let's unpack the headline numbers then for Ryanair's first fiscal quarter of 2026. They reported a pretty robust profit after tax, $820 million. Traffic was up 4%, hitting 58 million passengers. Then average fares, this was surprising, up 21%. Ancillary revenues also climbed, about 3%.
Yeah, and what's really fascinating here is the context that management made sure to highlight. While that profit number looks like a huge year-over-year jump, they were very clear. Q1 was artificially strong.
Artificially strong. Why is that?
Well, mainly because the comparison period last year was weak. Remember, Easter fell differently, and they were right in the middle of that OTA boycott, online travel agent alliance thing.
Ah, right. The boycott.
Exactly. So if you connect that to the bigger picture, maybe look at profit growth over 2 years, it still stands at a solid 24%, which, is a good performance by any measure.
Okay, that makes sense. And what about cost control? That's always a huge focus for Ryanair.
Yeah, it is. And this raises an important point. It's a real standout for them. Unit cost inflation, they held it to just 1% per passenger.
Only 1%. In this environment.
Exactly. Management sounded particularly pleased with this. They emphasized that the cost gap between Ryanair and, all its other EU competitors widened materially during the quarter. That really solidifies their competitive advantage, doesn't it?
It certainly does. Okay, beyond those initial figures, let's dig into some of the strategic decisions, the operational details. These really define their Q1 performance and outlook. First off, financial health. Their balance sheet looks exceptionally strong. They ended the quarter with $2 billion in net cash.
That's a very healthy position. It means they're well-placed to repay two pretty large bonds totaling $2.1 billion over the next 10 months.
$2 billion, wow.
Yeah, $850 million due in September, and then another $1.2 billion in May next year. And they expect to fund this entirely from internal cash resources.
No new debt needed then.
Seems not. That capacity for self-funding, it's a critical differentiator in this industry. Give them real flexibility.
And how are they managing fuel exposure? That's always a big risk.
They have a robust hedging strategy. For FY26, they've hedged 85% of their fuel needs at $76 a barrel.
Okay, that provides some certainty.
It does. And looking ahead to FY27, they've already secured 36% at a lower price, $66 a barrel. That's a 13% saving. They indicated they'll keep being opportunistic with hedging, trying to lock in good prices when the market allows.
Okay, now here's where it gets really interesting, I think. Their fleet and operational efficiency. They took delivery of 5 more Gamechanger aircraft in Q1.
That's right. Brings their total of these more fuel-efficient planes to 181.
And these are key to their growth plans.
Absolutely fundamental, especially for their constrained growth target this year, aiming for 3% growth. 206 million passengers.
Right.
But crucially, management expressed increased confidence in getting the remaining 29 delayed Gamechangers. They expect them well ahead of summer 2026.
And the MAX 10s. Any news there?
Yes, they also expect on-time contractual deliveries for their first 15 MAX 10s in spring 2027. They even mentioned having written confirmation from Boeing leadership on this.
Written confirmation. That sounds like a notable shift in tone regarding Boeing, given, past issues.
It certainly does. Management noted a, quote, dramatic improvement in the quality of Boeing's production. That's a big statement.
Definitely.
And they also made a pretty smart strategic move. They bought 30 spare LEAP 1B engines. Those are the ones for the Gamechangers from CFM. At a significant discount, too, apparently.
An opportunistic buy.
Very much so. It's to protect fleet resilience as that Gamechanger fleet keeps growing. And another thing they plan to announce in-house engine MRO shops later this year. maintenance, repair, and overhaul.
Bringing maintenance in-house.
Exactly. That would further widen their cost advantage over competitors who are stuffed with increasingly expensive third-party maintenance contracts. It's about long-term cost leadership.
Makes sense. So what's their take on the broader market, the competitive landscape? Seems like a lot is happening in European aviation.
They foresee pretty severe European short-haul capacity constraints continuing right through until 2030.
Until 2030? Why so long?
Primarily ongoing aircraft delivery delays from, both Boeing and Airbus, plus engine repair issues that are grounding planes at other airlines. So this environment, combined with their widening cost advantage and that strong balance sheet, they expect it to facilitate their controlled, profitable growth. They're still aiming for 300 million passengers by FY 2034.
Wow. And their thoughts on specific competitors? I know management doesn't usually hold back, especially regarding, say, Wizz Air.
Hey, no, they don't pull punches. Management was quite outspoken. They labeled Wizz Air a high-cost competitor, not really a true rival in their view.
High cost. Interesting framing.
Yeah, they pointed to what they see as strategic inconsistencies at Wizz Air, like pulling out of Abu Dhabi recently, shifting focus again. Ryanair believes this just highlights their own enormous cost advantage. They mentioned Wizz Air's expensive aircraft financing, significant net debt. They actually predict consolidation in Europe will likely see Wizz Air, quote, taken out as an independent carrier within 3 to 5 years.
Taken out. That's quite direct.
It is a very blunt assessment of the competitive dynamics.
Okay, so pulling all this together, what's the full year outlook?
Well, they're cautiously optimistic. They expect to recover almost all of last year's 7% 4-year fare decline, which, given their cost control, should lead to reasonable net profit growth for FY26.
But that huge 21% fare increase in Q1 isn't the new norm.
No, they expect Q2 to be more moderate, closer to maybe a 7% recovery of last year's Q2 decline. So Q1 was exceptional, not the baseline.
Got it. And what are the main uncertainties, the risks they're watching? The airline industry always has those.
Or definitely. The final outcome for the first half really depends heavily on close-in bookings for July, August, September, very late booking market, and visibility for the second half. Very limited right now. Only 6% of seats sold.
So still a lot that could happen.
Exactly. The full year remains exposed to, well, the usual suspects, adverse external events, maybe terrorism, tariff wars, microeconomic shocks, and critically, European ATC issues. Strikes, mismanagement, short staffing. That's a big one for them.
ATC strikes are a constant frustration, aren't they?
They cited a recent French ATC strike that cost them about $1.5 million in net profit. Canceled flights, reaccommodation costs, and management was pretty scathing about what they called the utter incompetence of the EU Commission for not protecting overflights during these national strikes. It's a recurring battle.
Okay, so taking a step back, how do these insights about Ryanair resonate with, say, the broader investor landscape? What does it all mean?
Well, this analysis really spotlights Ryanair's unique strategic advantages. I mean, their ability to generate substantial net cash, operate with an unencumbered balance sheet that positions them very distinctly in what's typically a cyclical, capital-intensive industry.
That financial strength gives them options others don't have.
Absolutely. It lets them make opportunistic moves, like buying those discounted engines, and it helps them weather unforeseen shocks, gives them resilience.
And that relentless focus on unit costs seems like the absolute core pillar.
It really is. Their commitment to widening that cost gap through the new Gamechanger aircraft, the future in-house MRO, it isn't just about efficiency tweaks. It's building a fundamental competitive moat that should drive sustained profitability. And it raises an important question for you listening. How will other airlines compete? Especially those with older fleets, higher debt burdens. How do they keep up in this environment?
That's a good question. What about the regulatory side? They seem very vocal there, too.
Oh, very. They're strong proponents for change in EU aviation policy, especially on protecting overflights during ATC strikes and also on the definition of free cabin baggage.
Right, the baggage policy debate.
Yeah. They're pretty candid remarks about some EU parliamentary actions, calling them madcap or less than intelligent. It underscores their frustration, but also their firm stance on what they see as their right to set pricing and policies. And the challenges they mentioned in places like Germany and Ireland, where they feel government inaction restricts capacity growth despite infrastructure being there, that highlights broader policy risks across Europe.
It definitely sounds like a company with a very clear, very long-term vision. Always looking several steps ahead.
Absolutely. You see it in the disciplined cash management, the commitment to returning excess cash to shareholders, buybacks, dividends, while still keeping a conservative balance sheet for strategic moves. It all paints a picture of a company focused on resilient long-term value. And their recent inclusion in the MSCI World Index, that just underscores their growing prominence on the global stage.
All right, it is time now for our This is not financial advice segment. And we always say, remember, this is purely for entertainment, for conceptual exploration. Always, always do your own research, consult a professional. But if we were pitching to an investment committee, here's an outrageous but plausible trade idea derived directly from this earnings call.
Okay. So given Ryanair's self-proclaimed status as this low-cost outlier, potentially uniquely debt-free soon, and their explicit confidence in that widening cost gap, consider this trade. The European air dominance pair trade. Long Ryanair, short the regional underperformer basket.
Okay, break that down. Long Ryanair, short a basket.
Right. The rationale is pretty clear from the call. Management was crystal clear on their widening unit cost advantage. They expect to be head and shoulders above everybody else for the foreseeable future, especially as those Gamechanger aircraft ramp up and they potentially bring engine MRO in-house.
And they specifically called out competitors.
Exactly. They openly criticized at least one high-cost competitor as ripe for consolidation. And they detailed how they're strategically shifting capacity out of places they see as high cost or government mismanaged, like certain airports in Germany and Dublin, and moving into regions actively cutting taxes or offering competitive airport fees, places like Warsaw, Modlin, Sweden, Hungary, regional Italy.
While other airlines are struggling.
Meanwhile, other European airlines are facing escalating third-party maintenance costs, longer grounding times because of engine repair backlogs. So the play is, initiate a long position in Ryanair. You're betting on their continued controlled, profitable growth towards that 300 million passenger target by FY 2034, driven by that unmatched cost base and their ability to capitalize on Europe's capacity constraints.
Okay, that's the long side.
Simultaneously, establish short positions in a carefully selected basket of European regional airlines. The ones particularly exposed to rising airport taxes, high labor costs, reliance on third-party maintenance, maybe government inaction on airport caps.
So you target the ones likely squeezed by the same trends that benefit Ryanair.
Precisely. This dual approach leverages Ryanair's explicit strengths and expected market share gains, while also kind of hedging against broader sector risks. You're targeting companies likely to underperform. It's essentially a bet on a stark divergence. A divergence in operational efficiency and strategic agility within the European short-haul market.
Interesting concept. Again, not financial advice, folks, just an idea sparked by the call. So as we wrap up this Talk Tickers deep dive, it seems pretty evident Ryanair is navigating the, let's face it, complex aviation sector with real confidence, underpinned by that strict cost control, strategic fleet moves, and a very strong balance sheet.
Indeed. Management did temper expectations a bit around those Q1 headline numbers, pointing out the artificial boost. But the underlying performance, the proactive cost management, their ability to capitalize on those industry-wide capacity constraints, it all reflects a robust, maybe cautiously optimistic outlook for continued profit recovery. And their willingness to call out regulatory issues and competitors really emphasizes their unique, sometimes combative position in the market.
And please remember, everyone, the insights we've shared today are for informational purposes only. They should definitely not be considered financial advice. Always consult with a qualified financial professional before making any investment decisions.
Yeah, and maybe reflect on Ryanair's long-term strategy, that continuous widening of the cost gap. What are the potential implications for the rest of European aviation? How might these pressures drive more consolidation? Where do you foresee the next big shifts in market dynamics or maybe emerging opportunities in the sector? Food for thought.
Absolutely. If you have more questions, or if there's a particular company earnings call you'd like us to dissect next time, please do let us know. We genuinely love digging into the details that matter most to you. Until next time, stay informed and make those intelligent, data-driven decisions.